The next section is going to be the general section, and this section provides a summary of the assumptions used for the analysis and a description and purpose of the reports. It's going to include a net worth statement, detail of the client's current assets, debts, insurance, and other items. It's also going to include a cash flow statement, liquidity analysis, and education funding reports. I'll be skipping the text pages, however, I do want to highlight this goal-based planning report. This is a great report to read. Golden Years also has the equivalent called cash flow planning, which I also recommend to read. It's great to read both of those report pages to get an understanding of the fundamental differences between Easy Money's goal-based planning approach and the optimized cash flow planning approach for Golden Years. So Easy Money uses goal-based planning, and it's going to be focusing on identifying the client's goals and determining if what they're doing now is enough to fulfill those goals. It's also going to use a more conservative or worst-case planning approach, and by that we mean that the pre-retirement period, the program is going to ignore their cash flow shortages or surpluses. So the program is only going to be saving what is scheduled as additions to their assets, not any surplus cash flow. The easiest way to explain this assumption is essentially just to look at if the client is not specifically saving the money by making a contribution to the asset, it's probably being spent. The program's also conservative when it comes to taxation. It uses the client's current marginal tax rate and assumes that their assets are fully turned over each year so the after-tax growth is reinvested. The objectives report is going to give you a summary of the client's needs or spending requirements related to the main goals essentially covered in Easy Money of retirement, survivor, education, or other financial goals. Objectives is followed up by the summary report, and this is going to provide a very brief overview of the client's ability to meet those planning goals or objectives listed on the previous page. Each of these objectives or goals and the client's ability to meet those goals is going to be explained in more detail later in the reports. The retirement summary is going to focus on the client's largest goal of retirement by listing the main assumptions for the retirement analysis, and it will also list at the bottom of the report shortage solutions in the situation where the client is projected to run out of money for their retirement situation. The next report is the net worth graph. This is, of course, going to illustrate the client's assets less liabilities to project their net worth. This graph is followed up by a more detailed numbers review, and that's the net worth statement. Multiple styles of the net worth statement are available. If you go back to the data input under assumptions and report options, you can see the different formats available. The consolidated format shows all the assets in a single column with a percentage of how much that asset makes up of their total net worth. The ownership style is going to break down the net worth by owner, so it's going to separate individual 1, 2, joint and community property, or trusts or other ownership. There's also a bank style view. This is going to lay out the assets on the left, the liabilities on the right, and it's a typical bank type format. And there's also an express style net worth. So now we get into some of those detailed report detailed report pages where it's going to list out the details of items entered in the program. So we start with asset details A6. This is going to detail out all the investment assets for the client. I just want to point out a couple things on this report page. So one thing we get questions on here is this column where it shows the additions. So you'll notice there's a left side and a right side. And so anything to the left of the slash here is going to be any personal contributions the client is making to the assets. Anything to the right is going to be company additions. So if it's something like a retirement account where the client is making a contribution and the company is also making a contribution, you'll see the clients to the left and the companies to the right. The other thing I want to point out here is this retirement column. So you'll notice it says yes for almost all the assets here for the sample case we're looking at today. If this does not say yes, this means that there's a box unchecked on the asset input. So if we go back to the asset input here, you'll notice this checkbox, check if used for retirement. Typically you do want this box checked. If you uncheck this box, that means that this asset is only going to be picked up for the client's current year net worth statement. It's not going to be included in the retirement projections. The last thing about asset details is there is multiple ways to sort the assets that are listed here. By default, they're going to be sorted by description. So it's going to be alphabetical. If we again look back under assumptions and report options, you can see the different sort styles available. So we're going to skip the rest of these detail type pages, which are going to be listing all the details of things like personal properties, liabilities, insurance, and the like. Next, we get into the asset summary. This is going to divide the assets into 3 different categories by type, class, and liquidity. The most important category for the assets is type. That's how the program is going to track the assets and determine the account taxation for the retirement projection. So it's going to group all their taxable accounts, for example, together and project those going forward as one pot of money. Next, we get into the liquidity reports. So when you are entering a liquidity type for each asset on the asset input, it's used purely for the liquidity analysis pages, which is this A12 and A13 pages, which are just going to display the client's ability to liquidate their assets to cash. It's also going to include their liquidity ratios for total assets, which is including things like personal property and residences, versus working assets, which is purely investment type assets. If your clients want to learn more about the different liquidity types, they can get a full description of each one on the following report, which is A13. So once we move on from liquidity, we get into their current year cash flow situation. So first is the cash flow graph. This is going to provide you a summary of a graphical view, essentially, of what we can see on the following report, which is their current year cash flow statement. This is going to detail out all the income and expenses for the current year line by line. So you can see every income item and every expense that's going to be factored in by the program. Again, if there is a surplus here, the program is not going to reinvest it. You can see as part of their expenses any scheduled additions that they're making to the assets. The program is only going to save those specific contributions to the assets. So if they have a large surplus, you might want to ask them, hey, what are you doing with this money? If they indeed are saving it, then you can turn around and enter an addition to one of their assets in order to account for that being saved. So moving on to financial goals, there's a specific data input. If we look back at the data input here, for financial goals is used for one-time large expense items. You can choose whether you want the expense of these goals included in the projections or not with this checkbox. The advantage of entering items under financial goals versus other expenses, they work kind of the same way for the reports, but this will, if you enter them in the financial goals section, it will be included for this financial goals report, which is going to outline some funding options for the client. So it's going to determine how much they would need to save in order to meet those financial goals, either if they were to put a lump sum away today or make monthly deposits between now and the year of the goal. So the last section we have in the general category is the education funding reports. So like financial goals, if you've entered dependent children and education funding needs, the program's going to determine what needs to happen essentially to meet those education funding needs. So either a lump sum deposit today or level monthly deposits. The monthly deposits assume level payments between now and the last child's last year of college. So if they mark that they have any current funds available or monthly savings that they're making to these education funds, that's going to be factored into the solutions listed at the bottom of the report, A19 and A21. So those are good reports to focus on. Also, we have A22, which is education separate accounts. Rather than making the level payments from now through the last child's last year of college, this is going to evaluate each child's education need separately. And the last report here for education and the general section is education funding sources. This is a great report. It's going to show how the education costs are currently funded. So when it comes to the projection, if we look back at the education options here, if we have the box checked to include the expense in the calculations, that means that the program will first pull from the education funds available as indicated in this category. And then if any of the education funds are uncovered, it's going to be picked up as an expense and be pulled from the parent's assets.